A PE ratio is just the price of the company in the market per share, so let's say $50 a share, divided by its earnings that year. So let's say the price in the market is 50 and the earnings are $5. So you simply divide $5 into 50 and you get this ratio of 10. So PE ratio of 10. Now, what's important about a PE ratio is that it reflects kind of what the market is willing to pay to get cash in the future, because PE ratio is related to the earnings and the price people are paying to buy those earnings. Now you need to know this is pretty key, that over the last 100 years, the average PE ratio in the stock market is 15 times earnings. So you know that $5 of earnings we were talking about? Well, what that company probably should sell for, if it's just a regular company, would be 5 times 15, or about 75 bucks per share. If it's selling for 50, it might be on sale. If it's selling for 100, it might be overpriced. Now, PE ratio is just the very beginning, crude way of looking at roughly what is the company value worth. But now, the 15 is about companies across the entire market. Really fast-growing companies will have a PE ratio in a good market typically of 2 times their growth rate. That's what we use when we're looking at the value of the business. So if a company is growing at 15% a year, we would probably give it a PE ratio of 30 in a good market. And if a company is growing at 7% a year, we'd probably give it a PE ratio of 14. Now, the reason that's coming to that doubling of the growth rate is because the average growth rate of companies over the whole history of the stock market is about 7.5% per year. And that's why it turns out that a 15 PE ratio is right on the button. Now, we don't stick to it. We just use it as a general marker, and it helps us start to figure out what's this business really worth, so we can figure out if it's worth $10 and we can buy it for $5, we might be very interested. If you enjoyed this video, please subscribe to my channel and visit rule1investing.com for more content. Now go play.